Hello everyone, welcome to Betty Academy. Our job is to make school easier. If you like our videos, kindly like, share, and subscribe. And don't forget to leave a comment down below. So in this lesson, we are going to learn about accounting concepts. So from accounting concepts, we have accounting concepts. It's make up the backbone of the accounting principle. These are the set of basic rules, laws, regulations, and assumptions which are kept in mind when entering a transaction in accounts books. So we have experienced accountants keep the entire accounts rule in mind when preparing an accounts book. These are common to accountants in their work as the air is around us. These are concepts and assumptions, and there is no evidence for this, but everyone in accounting believes that these concepts are self-evident. So today, in this lesson, we are going to start with the first concept. And the first concept is about the business entity concept. With the business entity concept, the business entity concept assumes that business owners are completely separate entities from the business. It means that the business is a standalone entity, and the accounting books are kept separated from the books of the business owners. The books are kept from the point of view of the business. So the owners are referred to as creditors to the business. So when an owner puts money into the business, it is seen as the owner extending a line of credit to the business. So at any no single circumstance are you supposed to mix your own individual earnings together with the earnings of the business, together with the expenses. Don't mix your own individual expenses together with the expenses of the business. At some point you lose track of how the business is performing. So that's what we have under business entity concept. So it means that the business owners are completely separate. They are completely separate entities from the business. So the second one, which is money measurement concept. Under money measurement concept, the money measurement concept refers to the transaction recorded by a business only in terms of money. What it means is that for a business, an account book can record only those transactions which involve monetary transfers. So if you remember our previous video, we talked about the kind of transactions, that you're supposed to capture in the books of accounts. And with those transactions, they must be business transactions, and that's why we have the money measurement concept here, because it involves capturing, recording those transactions in terms of money. So any other transfers or transactions which do not involve any money transfer are not recorded in the accounts books. This means that many important transfers which do not include money are not noted in the accounts books of the business. This concept also requires that a business also put a monetary value on its intangible assets, such as a brand name or intellectual property. Now let's go to the third one, which is the dual aspect concept. With the dual aspect concept, the dual aspect concept refers to the double entry bookkeeping method. It means each transaction must be noted twice, once on the debit side and secondly on the credit side. The dual aspect concept is very important because it helps balance the accounting books. When a transaction is noted 2 times on the opposite sides of the same balance sheet, it makes it incredibly easy to check whether the transactions recorded in the balance sheets are correct or wrong. It significantly reduces the chances of any financial mishaps happening. So that one, it only emphasizes on the double entry concept. The other concept is about the going concern concept. And with the going concern concept, accountants use this concept when there is a significant concern regarding the liquidation of the assets. The going concern concept is applied when the chances are high that the company would be liquidated in the next 2 or 4 quarters. Yeah. Usually, when keeping books, accountants do not think that the businesses would soon be bankrupt or be liquidated. This allows the accountants to put a price on assets that can be correct for a very long time, meaning that at any single time, whether the business is doing well or not, when preparing the books of accounts, accountants should have that one in mind. Have in mind that the business will be there for an indefinite period of time. The other concept is about the accounting period concept. The accounting period concept refers to the division of accounts records into similar multiple measured times. The time can be a quarter, semi-year, or a whole year. The performance of the company is measured and then disclosed to the investors in regular time periods. So what it means that when you're preparing your books of accounts, it does not necessarily have to start from January to December. So that one varies from one entity to another. There are those ones that will start from June all the way to July the other year. Others will do it on quarterly period, and others will do it on a half-year period, or probably a whole year. But it has to start from somewhere, and wherever it is starting from, that one depends with the entity. The time period for which a company discloses the information mainly depends upon whether the company is privately held or publicly listed. If it is publicly listed, it must disclose its performance every quarter. And when it means that it is publicly listed, it means that it's trading probably its securities on the stock exchange, or rather the securities exchange. So the moment we have those shares being, or rather those securities being traded in the securities exchange, it means that company is publicly listed. So it must disclose its performance every quarter. If it is a private company, it is left to the company on how or whether it discloses its financial performance. So let's go to the other concept, which is the cost concept. With the cost concept, it allows for the value of an asset to be noted in the balance sheet at the price at which it was purchased, or cost price, as opposed to the current price of that asset. So if an asset was bought, let's say a motor vehicle was bought 20 years ago, and the current price of the same asset has gone up, yeah, so it means that you, at no single time are you required to record it at the current price, rather the current market price. Yeah, so for example, machinery or equipment purchased would be noted at its purchased price rather than its current price, even if the machinery is very old and is not worth the purchased price. For this, depreciation is introduced to take into account a reduction in the price of an asset. So over time, we have this machinery depreciating in value, and what you're supposed to do, that one, the depreciation, the aspect of depreciation will reduce the price of that particular asset. So let's move to the other concept. The other concept is a matching concept. The matching concept refers to reporting of the revenues and expenses in the same time period. The revenues and expenses of a company must be recognized by the company under the same accounting period. So if you are doing on quarterly basis, let's assume that that's what you are doing with your accounting. You're accounting for a certain period. let's say for a quarter period, it means all the revenues and expenses that was earned and the expenses that were incurred in that particular period, they have to be recorded in the same period. They should not spill over to the other period. It is very important because if a company does not recognize the expenses and revenues under the same accounting period, it will lead to a mismatch between profits and loss and expenses, as profits may be overstated due to the mismatch between accounting timelines, right? Yeah, let's go to the other one, which is accrual concept. With the accrual concept allows for the income and expenses to be stated in the same accounting period that was incurred in, and not in the accounting period in which the income was obtained or the expenses were paid, right? Yeah, we are only looking at when the expenses were the expenses when they were obtained, and the income were obtained and the expenses were incurred. So we are not looking at when the expenses were paid, because when it comes to payment, it may really lag, or rather you may even pay in advance, right? So in this under accrual concept, we don't factor in when it was paid. We factor in when incomes are obtained and when expenses are incurred. So this is what we refer to as, this is what happens under accrual concept. But if you are to do basing on cash payments, when expenses, when you receive some income in form of cash, that's when you record, and expenses, when you do that, when you are paying, that one will fall under cash accounting. But this one, it's under accrual accounting. So a lot of times suppliers are not paid exactly when they deliver the goods, right? So the payment time can range from 1 week to 6 months. So the accrual period allows the supplier to note the income from delivering goods at the time those goods were delivered, and not the time when those goods were paid for. So the accrual concept allows for precise measurement of income and expenses, right? Yeah, so in conclusion, an accountant must have a complete grasp of all the important accounting concepts. These are the bases of the accounting. If the base is not good, then the bookkeeping would also not be good. So until next time, bye.